Hi, good morning, friends. Welcome back. So, आज Nachiket, what is today's topic?
Good morning, sir.
Good morning.
आज I was wondering if you can let us know what is mutual funds.
Oh, wow. Very interesting, huh? What is mutual funds? ठीक है, चलो. Let me just get the duster and the chalk. All right. So, what is mutual funds? Is this visible?
Not much.
Not
Yes,
much.
sir.
Is this
Better, better.
All right, so today's topic is what is mutual funds. So let's start a very basic thing with what is a mutual fund. So mutual fund or MF, okay, or mutual fund. So there are two words primarily. Okay, एक है word mutual, दूसरा है word fund. So fund means money. Okay, so it's a fund is money. All right. Mutual. Okay, what is mutual? Mutual is an agreement. So there are few people here. So there are investors, okay, who have mutually agreed. All right, this is working. Mutually agreed to invest. Okay. Okay. So they have mutually agreed to invest in a fund. In a fund. Okay. That's why it is called a mutual fund. Now, what have they mutually agreed upon? Okay. So there are few important, people that we should so one is an investor, okay, in a mutual fund. These people invest in a fund, okay. Let's look at the structure. So these people invest in a fund. This fund is managed by a set of people who are called fund managers. Okay, these are managed by a set of people of fund managers. All right, and this fund is invested in the market. Okay, so what can you make out? What you can make out is that these investors could have invested directly in the market, but instead of investing directly in the market, they are investing in a fund, and this fund is investing in the market. All right.
Okay.
So this fund, so mutual fund is like a vehicle. Like a vehicle takes you from one place to another place, a mutual fund also takes you as an investor, your money in the bank, into the market. It's a vehicle to invest in the market. Okay. So this is a mutual fund. Okay. Now, the whole purpose of bringing in a vehicle which helps an investor to invest in the market is that the investor possibly is not aware about when to invest in the market, how much to invest in the market, at what level to invest in the market, because this market there has inherent volatility. This mutual fund is run by a set of people who are called fund managers, and they are all professional, okay, professional people. They are all expert in this field. So they know how to read the markets far more than anybody else in the industry. So these investors depend on the professional expertise of these set of fund managers, and this set of fund managers decide when to invest in the market or when to exit from the market. All right. Now the question comes, so this point is clear, Nachiket? All right, perfect. Now the question comes, in which fund should one invest into? Now, there would be various kinds of investors in the market. So there could be an investor 1, investor 2, investor 3, investor 4, investor 5, investor. There are millions of investors in the market. The requirement of this investor 1 could be different from investor 2, could be different from investor 3, could be different from investor 4. So you cannot bring in everybody's money into the same fund, because this particular fund will have certain objectives to meet. So this particular fund might say that I am only investing into equity. Okay? And within equity, they can again break it up into large cap, mid cap, small cap, and all of that. I'm not getting into those details right now, but there could be a fund which is primarily investing into equity. There could be a fund which is primarily investing into debt securities. There could be a mutual fund which is primarily investing into gold. There could be a mutual fund which is primarily investing into REITs, and so on. All right. Now, and this, let's assume this investor 1 and 2 is interested to invest into equity. Investor 3 and 4 interested in investing into debt. So what really happens is that instead of bringing in everybody into the same fund, so there are multiple funds which are launched. Fund 1, Fund 2, and so on. Fund 1 invests into equity, Fund 2 invests into debt, Fund 3 invests into gold, Fund 4 invests into REITs, or something like that, real estate. Okay? So these set of investors who are aligned to what the objective is of a particular fund is, will be interested. So suppose these two investors think, okay, I'm looking for real growth of money. I'm looking for investment into equity. So they will select Fund 1. So that means every investor, so all the investors who invest into Fund 1 will have similar expectations or similar objectives.
So I have a question here.
Yes.
So what do you think, why one should not invest directly in equity and not in mutual funds? Or what do you suggest?
Why they should invest?
Direct equity or mutual funds?
Okay. So the answer is pretty straightforward. So as an investor, before investing in the market, okay, I need to be aware about the following things. Aware. Because you need to be an informed investor, because before taking a decision, you need to be aware about few things in order to help you decide. Number one, you should know in which companies to invest. Correct? In order to know which companies, that means you have to read their balance sheet. You have to read their profit and loss statement. You have to read any other guidance from the management. Okay, so this is one set. Second set is that this will help you to decide whether you want to invest in a company or not. Now, for you to decide, like I would like to invest into, let's say, 5 different companies. Now, this set of companies could be from various sectors. They could be from FMCG, correct? They could be from telecom. They could be from banking. So, before zeroing in on a company, you have to first do a sector analysis. Above sector analysis comes the macro analysis of the overall economy. So there are 3 levels. So you do a macro analysis, then you decide, all right, so India is a great story, so I decide to invest into India. Once you decide on that, then you get into sector analysis. And once you finish your sector analysis and you say, you know what, right now FMCG and telecom is looking well, I want to invest into companies. Then you start looking at all the companies within FMCG and then all the companies of telecom to decide on the first 5 companies. So this is called the top-down analysis. Top-down. So you go down from top and lower. The second set of analysis is the valuation. While you have decided to invest in a company, at what price should you invest? Correct? Now, companies, either the stock prices go up or they keep paying dividend. Okay? So sometimes people invest because they want regular income. So dividend income is something that they can, or the price. So the valuation. So this is then called the bottom up. So you look at valuations of companies and decide which one is relatively undervalued compared to somebody else. Okay, so you may decide, like let's assume FMCG set of companies are suppose going at X valuation. I'm not putting any numbers, just X valuation. Within FMCG, there are 3 companies. Ideally, you would look at companies where valuation is less than X, because you would like undervalued companies, companies where the prices haven't gone up yet, but eventually it will go up. So if the valuation of this company is above X, you might not invest in this. But if this one is below X, you will invest into it. So you will possibly select 1 and 3. So there is a lot of valuation related research which is also going in. So coming back to your short question, the long answer is that if as an investor, you are looking to invest directly into the market, you definitely have to go through this entire set of research yourself.
Correct.
Okay? But if you are going through a mutual fund, then the fund manager who is deciding to invest into the fund on your behalf decides it for you. So they are actually professionals. They get paid to take this decision, and hence it is, and they are into the thick and thin. For a normal investor, this will be one more additional piece of work for us. We have a 9-to-5 job, then we start to sit down and say we will do this. So possibly we will not be able to do justice to the need. But as a mutual fund, these fund managers are doing day in, day out this work. They are far more suitable to take these appropriate decisions. Hence, mutual fund actually works very well. Like if you fall sick, sometimes you do a self-medication, but then you go to a doctor who is a specialist.
Right.
Same thing happens for as an investment. For small little investments like opening a FD in a bank, you don't really need an advisor. But if you're going beyond bank,
Right.
small fevers, you take a crocin and you're fine. But beyond that, you go to a doctor. Same thing applies to a mutual, if your investment. So in the world of investments, it's always better to go to a professional.
So, what is the right time to invest in mutual funds?
So hope this part is clear to everybody. So I'll just wipe off this part of the board. All right. So what is a good time to start? So there are 3 things which drive returns. Okay. So everybody is looking at returns. Correct? So suppose, let us assume you are aged 25 and you are looking to retire at the age of 55. Okay. So you have got 30 years to build your wealth. So you are looking at a creation of a wealth. Okay. So that the life after 55 is nice. You are looking at a happy state of retirement. Why is this important? Because this is your working age, working life. Okay, this is the time you are earning money. So you will earn money, you will spend money. So your lifestyle is taken care of. After 55 or 60, you possibly will stop earning and you will be only spending. So there is no income. So there definitely has to be a wealth which takes care of the expenditures after 55. So if this is constant, just look at this. If this is constant, I would like this to be maximized. If 30, why not 31? Why not 32? So the best time to start investment is sooner than later. The sooner you start, the better it is. So this is one way of looking at it. Let me look at it in a different manner. Okay? So all of you who know a little bit about mathematics, one small point, there are 2 ways you calculate interest. One is simple interest, another is compound interest. Okay? Now what is the formula of simple interest? Simple interest is principal, the amount that you invest, multiplied by rate of interest that you are earning, multiplied by time. Whole divided by 100 is what you earn in simple interest. Compound interest is principal 1 plus r by 100, and the best part is that compound interest is where whatever you're earning in first year, suppose in the first year you are invested 100 rupees and you earn 10%, so it becomes 110. Next year on 110 you earn again 10%, so it becomes 121. So you earn interest on interest. So interest that you earn. So in life, Everything is compound interest. Suppose you have 500 rupees in a bank, you earn interest. Next year you will earn interest on interest. So that is compound interest. In compound interest, time is in the power. What does it mean? Amongst all these three, so there are three variables: how much you invest, what is the interest rate that you earn, and what is the time period for which you are earning this money. For compound interest, the time is in the power. So time is far more powerful in delivering the final return relative to how much you invest or what is the interest rate that you're earning.
Correct.
So suppose somebody says, you know what, I investing like 1 lakh rupees now, I'm earning 10% and I'll invest for 10 years. Relative to that, if somebody says, I will put in like 1 lakh rupees now, I will earn 10%, but I'll invest for 5 years. The second guy will always be worse off. Even if you earn more for a shorter period, or if you earn double for a shorter period, it really doesn't add up.
Correct.
So the sooner you start, the better it is.
Okay.
Great?
Great.
Super. So all the best, guys. So this is the first in the series of the mutual funds that we are going to start. Today was the first session. I welcome each one of you to like, subscribe our channel and comment on it. We will be more than happy to respond to all your questions. All the best and have a great day ahead. Bye-bye.